Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm speaking to James Rodda, Portfolio Manager of the Global Small and Mid-Cap Fund at Antipodes. With markets shifting and new themes emerging, he's going to share how he's finding value and managing risk in the global small and mid-cap space. Welcome, James.
Thanks for having me, Anna.
So to start us off, can you set the scene for the global small and mid-cap space and how that differs to what we typically see here in Australia?
I think in terms of global stocks, global small mid-cap space, there's around 50,000 stocks listed globally, 7,000 or 8,000 in the index. So it's just about more diversity. You can invest across all industries, all countries, and really pick out opportunities to attack sort of any form of change that's going on in the world. I guess versus global large caps as well, is worth noting that currently we're trading at a record discount to large caps. So the opportunity versus Australia is maybe more diversity, more ideas, but versus large caps, there's a record valuation discount at the moment.
So how are global SMIDs positioned within the current macro environment when we're looking at a softer US dollar, inflation pressures, and obviously tariffs all at play?
Look, softer US dollar is usually good for emerging markets, ex-US markets, relieves a lot of stresses and pressures, particularly on US dollar denominated debt. In terms of inflation, we're really at a point where I guess inflation has trended down and it's been sort of more neutralised, but risks around government spending can bring that back. I think in small and mid caps we have a range of ways to play that. Obviously, a lot of non-labour inflation typically comes from goods, commodities. There's a lot of beneficiaries actually of inflation, and the small and mid-cap index is more diverse in terms of having exposure to those companies that can benefit. It's more difficult for smaller companies in general because a larger company can move their supply chain more easily, maybe spends more time planning it, maybe has more diversity to their business. So it's probably an opportunity for management teams in small and mid companies to show outperformance, but overall I'd probably say it's more difficult for them to navigate.
So walk us through your process. How does Antipodes go about uncovering opportunities in the space? If you can share your playbook.
So we have a pragmatic value approach to investing, which means we'll buy companies, more mature, slow growth companies through to faster growth companies. We're looking for really a discount to our assessed valuation, which will take into account that growth or that quality. The process itself is very industry research focused. So what does that mean in a nutshell? It means understand change. A differentiator for us would be that we look everywhere. We look globally. We look across all industries. There is change going on in all industries. And then we zero in on that change that's underappreciated. So typically what that will mean is lower downside, still with good upside. So there's lots of change that's very obvious and very appreciated. We tend to stay away from that for the most part, unless we think it's underappreciated. So we find that improves risk versus return. So the fund's been running for 3 years now, and the downside market capture is 50%, with upside capture in excess of 100%. So we think when you focus on that change, you do the industry research to see all the disruption or whether a cycle is going to play out, you significantly reduce your risk. Probably the last thing I'd say is active management is critical in SMIDs. They're more volatile than larger cap stocks, and that presents a lot of opportunities. So the portfolio is held across that range. There's 13 GIG sectors, but it's really held on expected return versus risk. And so we find that stocks can move up quite quickly without much changing, more quickly, and it happens more often and reduces your expected returns. That's using volatility to your advantage to exit. And likewise, stocks often fall 20, 30% for no good reason in SMID. It just happens much more frequently. And they're buying opportunities because your expected return goes up. So we're reasonably active in using the market movements to our advantage.
James, are there any sectors or themes that stand out to you right now as ripe opportunities for uncovering global SMIDs?
Yeah, look, I think there's opportunity in every sector. Again, our process is really to go across sectors and find the best opportunities within, and it's, the opportunities that are underappreciated. So I think property is a great one at the moment. Particularly in those property assets that are not held in REIT structures. So our second largest positions are property holding. We've got 2 in the top 10. We're looking at cap rates in excess of 15% on both of them. And you really, obviously in private markets, these assets will trade at significantly tighter yields. Defence components is particularly interesting in Europe. There's a lot of smaller companies that benefit from being part of the supply chain. So it's about finding those rare ones with sort of leading edge products out of Europe that have the technology and have been investing ahead of the current, let's call it, increase in government spend that you expect. I think software is interesting. Most small mid-cap software companies have been particularly bad investments over the last 12 months, believe it or not. There's a narrow group that are AI winners, but most have been perceived as losers because they're point products and they're not seen as platforms. We think there's several names there that will make that transition from AI loser to AI winner. And so that's particularly exciting.
So can you share a couple of names in your portfolio that are particularly exciting to you at the moment heading into 2026?
I'll start with one of the real estate examples, a company called Brookdale, which runs senior living facilities in the US. It's the 3rd largest player. It's in a corporate structure. If you look at the average of where the REITs trade, who have similar businesses, the per bed valuation that we're paying is well under half. If we look at the per bed valuation versus replacement cost, just above 200,000. Replacement cost is maybe 380,000. So there's great value. And then we want the industry change side. There's value, I think, all across real estate, right? But this has the great change story, and the change story is around the demographics. So that baby boomer population hitting the age of 80 is really the catalyst for a demand cycle for this industry. So we think demographics like high predictability, it's going to grow patients 6, 7, 8% over the coming 5 years. And against that, you've got lower returns on the assets at the moment. That means the build cycle is actually collapsing. And so what you need a build cycle to be incentivized. The best way for that to happen is profitability to inflect significantly, which happens in most industries when demand accelerates against weak supply. So we think that's interesting. To put it in context, that position, if it hits just replacement value of the assets, there's a bit of leverage in the structure per most property companies. If we think it hits replacement value, we triple our money. Another one I'd probably talk about is offshore oil. Not one of those change stories I mentioned before, but it is a really interesting change story. So again, if I just start with the industry, most oil production growth over the last decade has come from US shale, so onshore production. And really offshore deepwater oil production has been seen as expensive, slow to bring on new capacity, and thus less competitive with something that can be easily turned up or down. We think that shale has kind of hit a plateau or a peak in the US, and oil demand will continue. And so the most obvious place for that is this deepwater offshore exploration. And so the last boom there was when we heard about peak oil was in the headlines, sort of 2008. Oil was $150, let's call it $300 in today's money, and people needed to spend offshore. We had a huge cycle there. So the drill rigs that cost around $1 billion if you would order a new one today, the fleet doubled in capacity. There was lots of ordering, and industry profitability has been horrible for an extended period of time. That's come right back down, actually not too far it was before those above peaks due to scrapping mainly. We think that utilisation will get to 90% next year, and there's a 5-year runway for growing demand and that utilisation to get to that point where demand exceeds capacity. We're buying Valaris. Valaris is the stock at around 250 million per rig. And if you think about something that's got $1 billion replacement cost and there's no shipyard capacity, you could have a long cycle of profitability. So the first thing that would need to happen to get more supply would be they'd need to make 20% return on replacement costs. That's 200 million a year. We're paying 250. They'd need to do that for a few years before they order. And then when they order, it's going to take 3 years to bring one on. So you've got a really interesting setup for a cycle.
On the flip side, what's a stock or two that you've recently exited or trimmed, and can you tell us why?
We exit and trim stocks mathematically for one reason, which is our expected return moves lower than other opportunities that we have with similar risk characteristics or in a similar broad industry set. So that can happen because the stock moves up. It can happen because you're wrong, stock moves down and you change your assessment of the valuation. Or it can happen because you just increase your risk. So probably I'd talk about one. Recently we sold Flutter, which is obviously mainly a sports betting company. Really in the US, what's happening is all these unregulated exchanges that are treated as futures markets are coming in and competing. They don't have to pay the taxes. They offer consumers better prices, better product, better service. And so a few months ago, we trimmed that position. It's subsequently come off on those risks. It had been a stock that we'd held since inception for nearly 3 years in the fund, so we did really well of it. But that one was, the risk and the confidence in that industry growth story continuing was really decreased, and we saw structural change in the industry. Another one that we trimmed recently or exited would be, Ayala Land, so a real estate company, not a REIT in the Philippines. We actually owned this one for a very short period of time. We owned it at a large size for a short period of time. We bought it, it went up 30% quite quickly, and after that we actually rotated our money into better real estate opportunities with higher return. And that's typically what we'll do. There's not necessarily an issue that we saw there. It was a more expected return, became more favourable elsewhere, so we rotated the money.
When you say a short period of time, how short are we talking?
We were a bit lucky with that one. We probably held a large position for 6 weeks, and it sort of moved 25%, and it's a pretty steady company.
Okay.
So yeah.
Interesting. All right, so you've managed this strategy for 3 years and now it's being launched into an active ETF. What prompted that move and how does it fit within Antipodes' broader approach?
Within our broader approach, we have 3 globally focused funds, Global Value Fund, the Global Long Short Fund, and the Global SMID Cap Fund, which is what we're talking about today, obviously. The approach is the same. It's the same team. We have a team of 31 investment professionals, which is, I think the scale you sort of need or you want to be able to do that deep dive industry research, speak to everyone you need to speak to, think about it properly, work out how you can lose, cover your risks. So that research works across the large caps in the industries and the small caps in the industries. Knowledge on the large caps benefits our smaller names, obviously. So that's sort of where it fits. But in terms of why we're bringing it to market as a ETF, the ticker will be MIDS, M-I-D-S, lists on November 10th. We're bringing it to market because demand. And really, I think investors have had good success in small and mid caps in Australia, be it in their personal portfolios or via fund managers, active fund managers. We think active management makes a lot of sense, particularly with that volatility I spoke about before in small and mid caps, but most Australian investors won't access global markets like they can access Australian markets. So you can buy a portfolio of 60 stocks that's quite diversified, exposed to small and mid cap companies on the ASX. We think that's we think that's compelling, and that's sort of what we're offering.
James, as we look to 2026 and beyond, what do you see as the biggest risks and the biggest opportunities for the global small and mid-cap landscape?
I think the volatility continues. Upside volatility, downside volatility at different times. So I think that's just always great for active management in SMIDs, taking advantage of that to move your positions around and improve your expected return as the market gives you opportunities. I think the big picture opportunity is fantastic with that record discount to large caps that I mentioned. The index sort of needs to move up 50% to reach those large cap multiples. Typically, obviously, historically over long periods of time, it's traded at a premium. The risks around macro are, more of the same stuff, right? So I think it's a lot of the COVID handouts have been depleted, particularly in the US, via that bottom 50% of consumers. So spending power is reduced. That can lead to demand shocks for products that consumers buy, which feeds through to a lot of even B2B work. So it has broad-ranging impacts. The other thing that obviously is always there is governments overspending, and so any deficit reduction can really slow economic growth. Again, we know that's been most prevalent in the US, the increase in deficits, but it's globally somewhat true. That would slow down. And on the other side of that, if they don't do that, that inflation question that you came in with at the start starts to come into play. The good thing is there's always a lot of change going on in the world, and you want to stay on the right side of that change at an industry level and a company level, and there's just a lot of opportunities to pick from. So, our portfolio is probably tilted a bit more defensively than it has been, given run-ups. But yeah, again, I think if you're investing for the long term, those sell-offs and those risks eventuating present opportunities to redeploy into things that are perhaps more hit by whatever the crisis or perceived increase in risk is at any given point in time.
Okay, great. Thanks, James, for sitting down with Livewire today and sharing your insights.
Great. Thanks, Anna.
If you enjoyed that interview, give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.